In September 2008, Lehman Brothers collapsed, and the American housing market entered the worst crisis since the Great Depression. Over the next 4 years, approximately 4 million American families lost their homes to foreclosure. Neighborhoods that had been stable working-class communities for generations became streets of abandoned properties, overgrown lawns, and for sale signs that nobody was buying. For those 4 million families, it was a catastrophe. For a small group of private equity firms and their investors, it was an opportunity. Starting in 2012, as housing prices reached their post-crisis bottom, these firms began buying foreclosed single-family homes at unprecedented scale. Not 10 homes, not 100 homes, not even 1,000 homes, tens of thousands of homes, eventually hundreds of thousands of homes. In some cases, buying entire neighborhoods. In some cases, outbidding ordinary families at foreclosure auctions with all cash offers that no individual buyer could match. In some cases, buying homes before they even reached the public market through bulk deals with banks desperate to clear distressed assets from their balance sheets. The largest of these buyers was a company called Invitation Homes, backed by the private equity giant Blackstone. At its peak, Invitation Homes owned approximately 80,000 single-family rental homes across the United States. It was the largest single-family landlord in American history. A company that had not existed before 2012 had within a decade become the landlord of 80,000 families. And Invitation Homes was not alone. American Homes for Rent, Progress Residential, Tricon Residential, and dozens of smaller funds collectively owned hundreds of thousands of additional homes. The total institutional ownership of single-family rental homes in America grew from essentially zero in 2011 to over 300,000 by 2017, and continues to grow. By the end of this video, you are going to understand exactly how this happened, why ordinary families were systematically outcompeted in the housing market by institutional buyers with billions in capital, what the consequences have been for renters, for communities, and for the broader housing market, and why the people who are supposed to regulate this market have done almost nothing to slow it down. This is the story of how Wall Street became your landlord, and what it costs you every month. To understand the institutional takeover of the single-family rental market, you need to understand what created the opportunity. The 2008 financial crisis produced the largest wave of residential foreclosures in American history. Between 2008 and 2012, approximately 4 million families lost their homes. These properties entered the market at distressed prices, often selling for 50 to 70% of their pre-crisis peak values. Under normal market conditions, this inventory of distressed properties would have been absorbed over several years by individual buyers, first-time homeowners, small investors, and renovation-focused entrepreneurs. The recovery would have been gradual but organic. The housing market would have returned to predominantly individual ownership. But 2012 was not normal market conditions. Mortgage lending standards had tightened dramatically in response to the crisis. First-time buyers who would have qualified for mortgages in 2006 could not qualify in 2012. The ordinary families who should have been buying the foreclosed properties were locked out of the mortgage market by tighter standards and reduced lending appetite. Into this gap stepped the private equity firms. They had capital that did not depend on mortgage lending. They could buy with cash, close quickly, and acquire properties in bulk. They had access to institutional capital from pension funds, sovereign wealth funds, and endowments that were searching for yield in a zero-interest rate environment. And they had something ordinary buyers did not have in this market: the ability to operate at scale. The operational innovation that made institutional single-family rental viable was technology. Managing 80,000 individual homes spread across dozens of markets had never been attempted before, because it had always seemed operationally impossible. A traditional landlord with 100 properties might know each tenant personally, respond to maintenance issues directly, have relationships with local contractors. Invitation Homes and its competitors solved the management problem through technology and standardization. Properties were acquired based on algorithmic assessment of location, condition, and rental market characteristics. Renovation was standardized to consistent templates. Rent was set by pricing algorithms that adjusted based on local market conditions. Maintenance was managed through centralized call centers and contractor networks. The technology turned what had previously required intimate local knowledge into a data management problem. The business model that emerged was straightforward: buy homes at distressed prices, renovate them to a standardized template, rent them at market rates, manage them at low cost through technology and scale, finance the portfolio with debt as values recover, eventually take the company public, or sell the portfolio at a profit reflecting the recovered values. Blackstone launched Invitation Homes in 2012 with an initial investment of several $100 million. Within 2 years, the company had spent over $7 billion acquiring properties. At its peak acquisition rate, Invitation Homes was buying approximately 1,000 homes per week. The scale of the operation required dedicated acquisition teams in every major market, relationships with banks selling bulk foreclosure portfolios, and algorithmic systems that could evaluate properties and submit cash offers faster than any individual buyer could act. The impact on ordinary home buyers in the markets where institutional investors were most active was documented extensively. In Atlanta, Phoenix, Las Vegas, Tampa, and Charlotte, the markets where Invitation Homes and its competitors concentrated their buying, cash offers for entry-level single-family homes multiplied dramatically between 2012 and 2014. Families who had saved for down payments and obtained mortgage pre-approvals found themselves repeatedly outbid by all-cash institutional buyers. The dream of home ownership, already disrupted by the crisis, was being disrupted again by competitors with billions in capital. This displacement had long-term consequences that went beyond the immediate frustration of losing a bidding war. Families who could not buy became renters. Many of them rented from the same institutional investors who had outbid them. The transition from potential homeowner to actual renter was not a neutral financial outcome. It was a transition from building equity to paying rent, from accumulating wealth to transferring it to a landlord. The rent itself became a subject of significant controversy. Invitation Homes and its competitors were accused of using their scale and their algorithmic pricing to charge rents that exceeded what competitive individual landlords would have charged. A 2022 investigation by ProPublica documented the use of a pricing software called RealPage by multiple large landlords. RealPage's algorithm, which collected rental pricing data from participating landlords and used it to recommend optimal rental rates, was accused of enabling coordination among competing landlords that resulted in rents higher than a competitive market would have produced. The Department of Justice opened an investigation into whether the use of RealPage constituted price fixing under antitrust law. The investigation was ongoing as of 2024. The core legal question was whether competing landlords sharing pricing data through a common algorithm constituted the kind of coordination that antitrust law prohibits, even without explicit agreement between the firms. Beyond the pricing controversy, institutional landlords were criticized for the quality of their property management. Tenants of Invitation Homes and similar companies filed complaints about delayed maintenance responses, aggressive fee structures, and the impersonal nature of dealing with a centralized corporate landlord rather than an individual owner. Class action lawsuits were filed in multiple states alleging systematic overcharging for repairs and fees. The fee structure that institutional landlords developed was itself a significant revenue stream beyond rent. Late fees, pet fees, application fees, lease renewal fees, smart home technology fees, fees for minor maintenance requests, fees for early lease termination. A tenant paying market rent was also subject to a menu of fees that could add hundreds of dollars annually to the cost of occupancy. The fee income was not incidental to the business model. It was a deliberate component of it. The communities where institutional landlords concentrated their ownership also experienced impacts beyond the individual tenant relationship. Research by academic economists documented that neighborhoods with high concentrations of institutional rental ownership experienced lower rates of homeownership, reduced community stability due to higher tenant turnover, different patterns of property maintenance than owner-occupied neighborhoods, and in some cases, reduced political participation, as renters are less likely than owners to engage in local civic life. The political response to institutional single-family rental ownership has been limited. Several states introduced legislation requiring disclosure of institutional landlord ownership, mandating notice periods before rent increases, or imposing restrictions on institutional buying in certain markets. None of these measures passed into law with the kind of comprehensive scope that the scale of the phenomenon might seem to warrant. The federal response was similarly muted. Congressional hearings were held in which executives from Invitation Homes and similar companies testified. Questions were asked. Concerns were expressed. Legislation was introduced that would have imposed additional taxes on institutional single-family rental purchases or prohibited institutional buying in certain circumstances. None of this legislation passed. The lobbying infrastructure defending institutional single-family rental was extensive. The major players, Blackstone, Invitation Homes, American Homes for Rent, and their trade associations spent millions annually on lobbying and political contributions. The argument they made was straightforward. They had provided capital to a distressed housing market when ordinary buyers could not. They had renovated and maintained properties that would otherwise have remained vacant and deteriorating. They provided rental housing to families who chose or needed to rent rather than own. They were a positive contribution to the housing ecosystem. This argument was not without merit. The properties that institutional investors bought were genuinely distressed. They were renovated and occupied when they might otherwise have remained vacant. The rental housing they provided was in some respects better maintained than the average individual landlord's property. The argument that institutional buyers should be condemned for responding rationally to the incentives the market provided was complicated. But the argument obscured a more fundamental question about what happens to housing markets and communities when the ownership of residential property concentrates in the hands of institutional investors, whose primary obligation is to their investors rather than their tenants or their communities. The single-family home as an asset class, as a source of equity accumulation for working-class families, as a foundation for community stability and political participation, performs differently when it is owned by a private equity fund than when it is owned by the family that lives in it. By 2024, the institutional single-family rental sector had evolved significantly from its post-crisis origins. The distressed buying opportunity that had launched Invitation Homes had closed as prices recovered. Institutional buyers were now competing for properties at full market prices, which changed the economics of the business model. Some firms had pivoted to building new single-family homes specifically for institutional rental, rather than acquiring existing properties. The build-to-rent sector, as this new approach was called, raised different questions. Institutional investors, constructing new homes, specifically designed to never be sold to individual owners, represented a permanent subtraction from the for-sale housing supply. In a market where housing supply was already severely constrained, the diversion of new construction capacity to permanent rental inventory was another mechanism through which institutional capital was reshaping the relationship between American families and homeownership. Blackstone eventually sold its stake in Invitation Homes through a public offering in 2017, having returned extraordinary profits to its investors. The company that had been created specifically to exploit the post-crisis housing opportunity had itself become a permanent institution. It continues to operate as a publicly traded company owning tens of thousands of single-family homes. The families who lost those 80,000 homes to foreclosure between 2008 and 2012 did not participate in the recovery of housing values that made Invitation Homes so profitable. They were renters during the recovery, often renters of the very homes they had lost, paying rent that contributed to the returns that made Blackstone's investors wealthy. The financial crisis transferred wealth from homeowners to banks. The institutional buying opportunity transferred the recovery from ordinary families to private equity. 200,000 homes. One financial crisis. A generation of renters who might otherwise have been owners. And a market that has been permanently changed by the discovery that single-family homes are not just places where families live. They are an asset class. And asset classes belong to whoever has the most capital. If you believe the public deserves to know where the money actually goes, subscribe. Every week, we cover the frauds, the scandals, and the financial crimes the system wants you to forget.